Stock market for beginners. David Jaffe with beststockstrategy.com. You can go to beststockstrategy.com and enter in your email address and receive $400 worth of free trading materials. So December of 2018 was the worst December in about 85 years since the Great Depression. In 2019, I think that there's going to be a substantial amount of volatility in the stock market. Now, most of the people who are watching this channel know that the only way that you can trade that provides you with a high statistical probability of profit is to sell option premium. Because by selling option premium, you are essentially becoming like an insurance salesman or a casino. You are taking high probability bets that have an 80 to 90% probability of making you a profit. So are you guaranteed to make a profit on every single trade that you made? No, of course not. In December of 2018, I lost money, which is completely cool because when you make money and you make millions of dollars by trading options, I'm completely okay with losing a little bit of money in December 2018. Thankfully, I was able to sell calls in December of 2018, which substantially reduced the losses that I experienced on the put side. But the fact is that you're not going to win every single time. And I believe that I'm one of the best traders in the world because I put the work in. And I'm going to teach you right now one of the best ways that I would recommend trading in 2019 so that you can make money. So the first thing is you need to set your account up so that you're able to sell option premium. I made a previous video about the best brokerages. Pretty much you can use Tastyworks. You can even use Robinhood. I'm not a big fan of it. I use Options House, which was recently purchased by E-Trade. But the fact is that if you can pretty much use any broker as long as it's legitimate, like an Interactive Broker, Schwab, Fidelity, Options House, E-Trade, Tastyworks, Thinkorswim, TD Ameritrade, etc. Now you can, let's say the commissions are a little bit higher than you want, you can call them and negotiate the commissions, and sometimes they offer you free sign-up bonuses. You can also you should also ask them for level 3 or level 4 trading access, which allows you to sell options like naked puts and calls. If they don't allow you to sell naked calls, which I believe is level 4, that's completely fine because a lot of times we're going to be using verticals anyway. So what I like to do, the first thing is you have to focus only on the most important things. So here, I just wrote down a watch list of stocks, and these are pretty much the only stocks that you should focus on in 2019. So you have Amazon, Raytheon, JP Morgan, Dollar General, McDonald's, and Visa. And the reason why I like these stocks is that for the most part, they're relatively recession-proof. I know that Amazon is not recession-proof, but Amazon right now is trading at around $1,500 and previously was trading at around $2,000. So if you're able to sell puts on Amazon with a strike price of around $1,200, then that would be great. So I'm going to put put and I'm going to put call. So here is, you should do a put for like $1,200. Raytheon right now is trading at around $160. So 140. JPM is trading at around 97. So let's say 89 would be the puts that you would sell. Dollar General right now is actually trading relatively, it's been holding up very well. That's trading around 109. So that's actually relatively high, so I would do like a 99. McDonald's is trading around 175. I would probably do like a 163. And Visa, I don't usually trade Visa that often. I think it's trading at around 135 or something. I barely trade it, but I should probably get clarity on this. But let's say you're gonna have a put with a price of, let's say, like 128. Okay, I'm not 100% sure on Visa because I don't really trade it that much. But in any case, so the reason why I'm putting these puts here is these are the puts that you should actually target. So right now Amazon is trading at around $15.50. So the only way that you should trade Amazon is if it falls to around $14.50, maybe $14.25, at which time you would sell like a 1,200 put. Raytheon right now is trading at around 160. You should wait for it to fall to around 155, then you can sell the 140. JP Morgan's around 97, you can wait for it to fall to around 95, then you can sell the 89. Dollar General, same thing. So it's trading around 108. You can wait for it to trade to around 104, 105, then you can sell the 99. The reason why I chose all these stocks is, as I said previously, Amazon is relatively recession proof, and it's a market leading stock. It's probably, I think, besides Microsoft, it's the largest company in the world. Raytheon is a defense contractor, so you do have some support there because it has government contracts and it has a lot of predictable revenue streams. When I worked in investment banking, we would always want to see the predictable revenue streams because it removes uncertainty. And when there's uncertainty, there's volatility in the marketplace. So you want to have defense contractors like Raytheon and Lockheed Martin in your portfolio because they are relatively stable. JP Morgan is a market leading investment bank, and they're trading too. They've also held up very well over the past 3 months. Dollar General is a counter-cyclical dollar store, and I read somewhere where around 40% of the people in the United States are now purchasing their food at dollar stores because they're small, they're very convenient, and it's cheap. And this is the best of breed. It's very well run. It's much better run than Dollar Tree. McDonald's, also cheap food. It has a great brand and it has predictable revenue streams. So this is also counter-cyclical. So if we hit a recession, then McDonald's will hold up very well. And Visa, which is the gold standard of payment processors. So as I said before, these are the strikes that you would target. You would target these strike prices. Now, if we have a recession and the market is going down, you also want to sell the call side. So what this means is that when the market increases in price, let's say the S&P 500 goes up like 50 points, you would then want to start selling calls. So on the call side, if Amazon right now is trading at around 1550, you would wait for it to trade to around 1625, and then you would target, I would say, around an 1820 call. Raytheon, you'd probably target around like the 182 call. JP Morgan, you'd probably sell like the 112. Dollar General, you'd probably target like the 117 or 118. McDonald's, you'd probably target, let's say, like the 189 call. And Visa, I definitely should have got clarity on specifically where Visa is trading, because out of all of these, Visa is the one that I don't trade that much at all. But with Visa, you probably want to target, I think, like the 155 call. Okay, so in this situation, just like I went through with the put side, if Amazon trades up to 1625 or 1650, then you would sell the 1820 call. If Raytheon increases in price to around like 168, then you would sell the 182 call. If JP Morgan increases in price to about $103, you would sell the 112. Dollar General, if it increases to around 111, you would sell the 118 call. McDonald's, if it increases in price to around 180, you would sell the 189. And Visa, I think, as I said, I think it's trading at around 140. And if Visa trades up to around 145, then you would trade the 155. Again, I'm sorry, I'm not 100% sure on Visa, so check this. And if you have any questions, you can leave a comment below and I'll answer it. But all the other ones I'm positive about. Visa I'm not, because out of all of them, Visa has very little volatility, and as a result, I don't really trade it that often. So the next question is, should you trade naked options or spreads? Usually I like trading naked options because it maximizes the amount of premium that you receive. It actually decreases your buying power reduction. So it decreases your buying power, so therefore it protects you inherently against the greed that a lot of people face, and therefore it protects them against trading too many contracts. Naked options are very easy to roll and to manage. Now I hear a lot of people say, and also it reduces your amount of commissions. I hear a lot of people say that with naked options you have like unlimited risk and it's substantially risky, but the probability is that you're much more likely to be profitable when you sell a naked option than you will with a vertical. And we can all bring things to the extreme in order to disprove an argument. Like, for example, Why should I go outside? I could potentially get hit by a car. Maybe there's 1/10 of 1% probability or 1/100th of 1% probability that I'm going to go outside and get hit by a car. As a result, I don't believe that the probability is enough for me to actually stay inside all day. So in this example, what's the probability that an $800 million company like Amazon is going to go bankrupt? Zero, or very close to zero. What's the probability that a company like Raytheon, which has government contracts that span for the next 10 or 20 years, is going to go bankrupt? So all this stuff, all these people who tell you that there is a substantial risk by trading naked options, they are not profitable traders. However, let me just tell you that over the past 3 months, the volatility that we've experienced in the market has made it so that I have been trading a lot more spreads. Just because in late December, there was a Wednesday where the S&P 500 was down 80 points. And then it actually, in 2.5 hours, it regained all of those 80 points and it closed up 20 points. This is volatility. This is like 2 or 3 standard deviation moves in one day, which is unheard of. So I definitely think that many people should be trading spreads, even though they're less advantageous, even though you're collecting less premium, they're harder to manage, they are a lot harder to roll, they have higher commissions, and also you're going to be motivated to trade more contracts because there's going to be a lower buying power reduction. I still believe that if you're able to deploy the strategy and exercise restraint and deterrent and be diligent in managing your positions without trading too many contracts, then many people, and myself included, are primarily going to default to trading spreads in 2019. And the main reason is that the spreads will protect you against the volatility that we have experienced in the marketplace and which may continue in the marketplace in 2019. So from a spread perspective, let's say Amazon trades down. Amazon right now is trading at around $1,550. Let's say Amazon trades down to $1,450. We would then sell a 1,200 put, and then we would buy an 1,100 put. Raytheon, if it trades down to around 154, 155, we would sell like maybe a 142, but let's just leave it. We would sell a 140 and we would buy a 130. Here, if JP Morgan trades down to around 95, we would sell an 89 and we would buy an 85 put. Dollar General, if Dollar General trades down to around 105, we would sell a 99 and then we would buy a 95 put. McDonald's, we would sell a 163 and buy like a 157. On the call side as well. So remember, we're entering these trades, and this is a very big difference between myself and Tasty Trade, where if it's an opportunistic opportunity for you to sell puts, that inherently means that it's an inopportune time to sell calls. So you should not enter a strangle by selling a put and a call at the same time, because in this situation, we're only selling the 1,200 put if Amazon drops down to around 1425 or 1450. If Amazon is trading at 1425 or 1450, we're not going to sell an 1820 call on Amazon because we're not going to collect any premium. So the only way that we would sell, so in this situation, we would opportunistically engage these positions in a strangle. So for example, if Amazon is trading right now at 1550 and then it trades up to 1650, we would then sell an 1820 call and then we would buy an 1860 call. So therefore we would create a vertical credit spread on the call side of this position. Then let's say a week later Amazon drops down from 1650. Remember, if Amazon increases in price to 1650, we sell an 1820 call, and then on the same ticket, we would buy an 1850 or 1860 call. So in that example, we would be short a vertical credit spread on the call side. And Amazon right now in that example is trading at 1650. Then let's say a week later, Amazon drops down to 1450. At that time, we would then sell a 1,200 put and buy an 1150 put. So then we would have an iron condor in that specific example, because we would be both short a call credit spread and a put credit spread. So in that situation, we would opportunistically enter into an iron condor, but we don't put both legs, the put and the call side, on at the same time. In this example, same thing. So JP Morgan right now is trading at around $97. On the call side, we would wait for it to increase in price to around 105, and then we would sell the 112 call, and then we would buy the 115 call. As a result, we would be short. We would collect more premium for selling the 112, and then we would buy the 115, so that would reduce our premium, and therefore we would have a call credit spread. Then, if 2 weeks later JP Morgan trades down to like $95, we would then initiate and sell and open a put credit spread by selling an 89 put and buying an 85 put. These trades will allow you to be profitable on 90 to 95% of your trades, and you can earn anywhere from 30 to 60% every single year consistently. You don't have to bang your head up against the wall and just hope that you're going to be profitable, or you don't have to give in to any fake gurus and who are trying to sell you like 3 simple chart patterns or indicators, which all of us know do not work. The last thing is, if you want to be profitable in the stock market and you want to trade stocks and do extremely well, then for the stock market for beginners, in this video, the best thing that you can do is, once you enter these trades, you immediately put a buy to close order in. So in this example with Amazon, where Amazon is trading right now at around $15.50, we wait for it to trade to $14.50, then we would sell a 1200 put and we would buy an 1150 put. So we will be short in a 1200 1150 put spread. Let's say in that situation we were able to collect, let's say $6 per share for a 1200 1150 put spread. Okay, so we collected $6. In this situation, once this order fills, we would immediately enter a buy to close order with a limit price of $3. So once this triggers, once we have this position open in our account, we would submit a buy to close limit order. Now the time in force would be GTC, which is good to cancel. That way you're not submitting day orders so it doesn't get canceled and then you have to resubmit the same order all the time. So if this fills and you collect $6 of premium, that's $600 for every vertical credit spread that you would sell, you would immediately enter a buy to close limit order with the time in force of good to cancel for $3. As a result, on a net basis, you would collect and keep $300 for every contract and every spread that you sell, less the commissions. And that's how we make money. We close out our trades early, we only trade the best, most stable underlyings, and we only trade A+ opportunities, and we are very patient and we wait for our opportunities. David Jaffe with beststockstrategy.com. I have hundreds of students. If you want free training, you can go to beststockstrategy.com and enter in your email address and receive over $400 worth of free training materials. I offer the best trade alerts and also the best education available. If you have any questions, I'm here to help you. Please like, comment, share, and subscribe to this channel. And if you have any questions, like I said, leave a comment. I answer everyone, and I appreciate your attention.